Q1FY22 earnings conference call of Chalet Hotels Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Ruchi Rudra. Thank you, and over to you, ma'am.
Good morning, ladies and gentlemen. Welcome to the first quarter financial year 2022 performance call for Chalet Hotels Limited. We have with us Mr. Sanjay Sethi, the Managing Director and CEO, and Mr. Milind Warekar, our CFO, to take you through the performance and respond to your queries. Let me make the usual disclaimer on forward-looking statements and rounding off of numbers. Kindly refer to our presentation, which has been made available on the stock exchanges and on our website for the details of the same. I now hand over the line to Mr. Sethi to share his opening remarks.
Thank you, Ruchi. Good morning, everyone. All of you are safe and doing well. As you're aware, the second wave swept the nation and impacted businesses in Q1 of this year. The restrictions brought many cities to a standstill, and hospitality business was hit hard. On a positive side, we have seen a flattening of the curve in June, reflecting well on the business. At the onset of the second wave in March 21, the state of Maharashtra imposed full lockdown from 4th of April till 7th of June, literally impacting 2/3 of the quarter. Similar lockdowns were witnessed in Maharashtra and Telangana also. In Karnataka and Telangana also. There has been a phased opening in these states. Hyderabad has opened up a lot quicker. Maharashtra has been slow to open up, and F&B is still restricted till 4 p.m. in Maharashtra. Now, the good news, the months of June and July saw improving consumer sentiments with sharp pickup in business and leisure segments. We see a similar trend for the month of August. The ramp-up in occupancies was stronger post the second wave as compared to the first wave, indicative of resilience of travel and confidence of the travelers. US has 50% and UK 58% of its total population vaccinated. Both are key source geographies for Chalet. The European Union, Middle East, and several other geographies have opened their countries for tourism for fully vaccinated travelers under the Vaccine Passport initiative. Some of the top global companies have announced back-to-work plans, and several of them have also announced reopening dates. For our overall portfolio, April occupancies were 36%. May had a steep drop to 23% occupancies. However, June saw a smart recovery at 47% occupancies. The month of July continued to follow the trend with portfolio occupancies at 54%. The month of July has actually recorded the highest revenue, occupancy, and RevPAR since the pandemic started. Business continues to come from the segments of Bollywood shoots, IPL, seafarers, and social functions, and now banking, financial services, and project-related businesses are showing strong shoots of recovery. The restrictions on dine-in services and banquets impacted the performance of food and beverage. Contribution from F&B segment was 131 million for Q1 against 273 million for the previous quarter. On the P&L front, in Q1, we received a rebate from one of our operators on the past disputed liability of 37 million on reimbursements. Excluding this, the revenue for the quarter was 715 million, higher 21% year-on-year. Milind will take you through some of the details later. Our cost control measures since the beginning of the pandemic have kept the fixed costs 46% lower as compared to the pre-COVID comparable of Q1FY20. For the hospitality division, variable costs are in line with revenue levels and were down by around 70% for the quarter. Our staff-to-room ratio, a key metric for hospitality, further improved to 0.7 as of June 21 from 0.74 as of March 21. on improved efficiencies at our hotels. We report all employees, including those on contract and outsourced services, for this calculation. Utility cost at absolute level was down by 11% sequentially for hospitality in Q1 FY22, while maintaining the unit consumption efficiency on a per room basis. Reported EBITDA for the quarter was negative 31 million. This, however, includes a one-time charge of 94 million for interest payable on cancellation to 6 flat owners who have decided not to continue with the Koramangala project. As you know, these cancellations are funded by the promoters on a cash flow fund, and we can elaborate this further in the Q&A session. Adjusted for this and the rebate from our operator, the EBITDA for the quarter was at 25 million as against 51 million reported in the preceding quarter. On the non-hotel assets, rentals from our commercial tenants were stable for the quarter. We have, as I mentioned earlier, given some relief on CAM and parking area charges. That continues for this quarter also. The Innovate Mall in Bengaluru was closed for the months of May and June because of the restrictions in the city impacting the mall's performance. The repurposing of the space at the Orb at Sahar, Mumbai is underway, with majority of the area being converted to commercial offices. Select F&B outlets will continue to operate, providing the necessary F&B to the office occupants. On the growth pipeline, the two commercial development projects are progressing well and in line with the timelines shared in our previous call. We continue to evaluate demand dynamics to assess the opening of the new hotel in Hyderabad, expansion of capacity in Pune, and the rebranding of the Powai Hotel. Our mission to go green as a company is gathering further momentum since our last update on EV100, which focuses on accelerating transition to electric vehicles. We are now committing to EP100 on energy productivity and RE100 on renewable energy. Our applications have been submitted and are under consideration with the climate group. I would also like to update you that we have started the process of application for the Dow Jones Sustainability Index, or DJSI as it's known, ranking on ESG parameters. I'm also very happy to share that Chalet received the 6th rank in Great Places to Work in mid-segment companies in India. This is 10 notches higher than the previous ranking last year. In addition, Chalet Hotels has also been ranked 40th in the best places to work in Asia in a similar category. These recognitions reinforce the power of strong human resource practices at Chalet Hotels. Ladies and gentlemen, whilst we have had a longish rough patch, the strategic mix of our asset classes in our portfolio has and will hold us well in the coming years. Chalet also has significant value that can be unlocked from its existing balance sheet, and we look forward to discussing the same in the near future. Now, please do join me in congratulating Milind, who has been promoted to the position of CFO of Chalet Hotels. And I hand over the proceedings to Milind now to take you through some of the key financials. Milind.
Thank you, Sanjay. Good morning, ladies and gentlemen. The first quarter of this year started in the midst of second wave with resurfacing of lockdowns, and our performance reflect the same. Reported revenue for the quarter was 753 million, which includes a rebate received from operating partner of rupees 37 million for past disputed liabilities. Adjusted for this, the revenue was at 715 million for the quarter, which was sequentially down by 30%. EBITDA for the quarter was negative 31 million, which additionally included rupees 94 million on account of interest on cancellation of 6 flats in Koramangala. Adjusting for these rebate, EBITDA for Q1 was positive of rupees 25 million. PBT post charges on depreciation and interest for the company was negative of 638 million as against negative of 475 million in the sequential quarter of Q4. After taking credit for deferred tax asset of 275 million, loss after tax was at rupees 363 million. The hospitality segment contributed to 66% of the total revenue of the company in Q1FY21. Occupancy for the quarter averaged at 36%, lower by 3 percentage points sequentially, largely due to drop in occupancy in the month of May. The RevPAR for the same period was at rupees 1,252 rupees as against 1,610. On a year-on-year comparison, occupancy is up 12 percentage points and the RevPAR is up 35%. Adjusted for the rebate, the revenue for hospitality was rupees 462 million in the quarter as against 724 million in Q4 and rupees 312 million in Q1 of last year. EBITDA loss adjusted for rebate was at rupees 99 million against profit of 19 million in Q4 and loss of 145 million in Q1 of the previous year. On the cost front, we continue to maintain lower fixed and variable costs compared to our pre-COVID performance. Fixed cost was lower by approximately 46% and variable costs were lower by 70% as compared to pre-COVID Q1 of FY20. The variable costs are expected to rationalize as operations scale up, whereas our strategic initiatives on cost will keep the variable cost contribution lower than traditional levels. On retail and commercial front, we have received steady rental income from commercial assets, and the revenue and EBITDA from retail and commercial segment was at 233 million and rupees 191 million for the quarter respectively. As mentioned by Sanjay, Inorbit Mall at Bangalore was closed due to lockdown for 2 months, and we are currently in the process of repurposing the OB at Sahar. We expect the contribution from retail, and hence the contribution from retail operations has been lower for the quarter. With the conversion of large part of the OB at Sahar to commercial office space, we'll be hedging the portfolio further. The new setup is likely to be EBITDA and return ratios accretive. Net debt of the company as on 30th June was at 1953 crores as against 1871 crores, a total increase of around 83 crores in the period. The capex spent during the same period was 34 crores. Our cash burn, that is EBITDA less finance cost, for Q1 FY21 has been 39 crores led by prudent cash flows and working capital management. The average cost of rupee loan is now at 7.92 as against 8.04 at the beginning of the year. The cost of all loans is in the range of 8%. We have cash and cash equivalent as of June 21 of rupees 77 crores and rupees 780 crores available lines of credit for general corporate purpose and planned capex. There has been no new subscription from promoters on 0% non-convertible redeemable preference shares for funding the outflow relating to residential project at Koramangala during the period under review. Since we have recommenced negotiations with the flat owners for new plan, a majority of existing owners, bearing 9, have consented to continue with the project. Of these, 6 customers have exited from the project and payments have been made, while the remaining 3 customers have expressed their desire to exit. However, final exit documents are awaited. We are awaiting final clearances from regulatory authorities and court to recommence work at site. A suitable announcement will be made for the same once the approvals are in place. With this, we now open the floor to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Bagal from Axis Capital. Please go ahead.
Thank you. Congratulations to the entire team at Chalet for a reasonable performance amid really challenging times, and congratulations, Milind sir, on the promotion. Sir, I have 3 questions. Firstly, Sanjay, if you can help me understand a little more in terms of the texture of our occupancy. You did allude to improvements across the board in our customer set. But if you can give us a little more texture in terms of how do you see the corporate shaping up over the next 3 to 4 months, and if you've got any learnings from our Marriott and other brand partners from how international travel is likely to play out over the next 6 to 12 months, that would be helpful. That's my question number 1. My question number 2 is essentially in terms of our employee to room ratio, we've done a spectacular job there. But assuming that we were to go back to, let's say, 70% occupancy, what would be a steady state number there? I also have a third question, but I'll come back to it.
Thank you, Aditya, and Mr. Always a pleasure to speak with you. Overall, the state of travel is still in a state of flux. And therefore, a lot of the business that we're getting right now is business that is being created out of opportunities in the current environment. The good part is that we've been able to capitalize on those opportunities well and have been able to report high occupancies. To answer your question specifically on the business travel, I think everyone here on this call will know that that's still nowhere near normalcy right now. And if you were to open up or look at the DGCA site on passenger loads on aircraft, you'll realize that we are still at about 30% of the same period 2019 numbers. And that's not a great sign. But what we are looking at is the pace of future bookings. Second, we are looking at what's happening in various companies and industries. On the industries front, we see hiring patterns to be encouraging. On the companies front, as I mentioned earlier, we see announcements of back to work happening. And finally, on the health front, the vaccination that's happening on the ground in India and elsewhere in the world is encouraging. Today, India has 400 million people who received the first dose, 113 million and a little over that who received the second dose. And with approximately 5.5 million to 6 million people getting vaccinated every day, this should ramp up fairly quickly. And we are still awaiting the final on-ground execution of the new vaccines. The moment those 3 or 4 new vaccines come into play, this vaccination pace should at least double. Overall, our view is that the domestic business travel will be back in Q3 to at least 50 to 60% of pre-COVID numbers. International travel, however, will probably have a lag of a couple of quarters after that. Currently, so roughly around 15 to 20% or maybe 20 to 25% of our business comes from business travel because, and I'm saying this from the numbers that I see here, that 15% of the in-house residents in Q1 for us were foreigners. Now, clearly, they're not here for leisure travel.
Right.
So they're here for work. So if we have 15% coming out of foreigners, we can add another 10 to 12% from domestic business travelers. Roughly between 25 to 30% of the rooms nights that we've done are coming now from business travel. I've taken a few flights in the recent weeks. My colleagues have done that. We are now for the first time seeing on the aircraft very obvious business travelers on the aircraft, which indicates business travel is back. Finally, I think there were two points of our business travel. One was the companies were not ready to take the risk, but then companies are not ready to even call them back to work. Back to work is happening. Travel, the one bottleneck was the scare about breathing common air on an aircraft. I think the airline industry has done a fabulous job of making people comfortable that they have it all under control. So that fear is largely out of people's mind. Rooms, in any case, were never the problem because the air conditioning in rooms in hotels is individual. There's no cross transfer of the air from one room to the other. So with all that in place and largely the WHO recommendation that the transmission through surfaces is almost negligible, has given a lot of comfort for people to travel. And if people can travel in large volumes for leisure, when the need for business travel arises, there's no reason why they won't travel for business too. Coming to your second question, employee to room ratio on a steady count, we believe that when we hit back that 75% occupancies that Chalet was at in the pre-COVID period, we should be back to at the highest of 0.9 employees to a room. As a reference, we were 1.22 when we listed the company. We had come down to a little over 1.1 pre-pandemic. Our target that time was 1 employee to a room. Our fresh target on normalized basis is 0.9 employees to a room. And when I say 0.9, I want to emphasize this includes contract employees, fixed-term contracts, outsourced employees, all of them. This is not just permanent employees on our rolls.
Great. Sanjay, I think that is a commendable job in terms of efficiency that we've done, not only in terms of our employees, but also in terms of our fixed cost. The last question that I had was on our Koramangala project. I mean, this has been in limbo ever since our IPO. Just wanted to get a status update. How do we see the pickup in that project? Any timelines that you would like to share, or at the time of an IPO, there were various discussions that we did in terms of what kind of eventual NPV Chalet could realize. If there are any indications that you can share, that would be very helpful.
So, Aditya, I can't give you information that is unannounced in the general public domain as of now. But what I can share with you is the progress on the Koramangala side. There were 3 or 4 hurdles to this Koramangala project. One was that HAL had withdrawn its approval.
Right.
Second was, because of that, we were not getting the approvals to build. Third was, if we went with 10 stories only, there were a certain number of buyers who were above the 10th floor, who we needed to move to the lower floors. So let me take you through one by one what has happened till now. The fire NOC has been received. The 92 flat owners that were there, and I think Milind touched on it a little earlier, out of the 92 flat owners, 83 have confirmed that they will continue, and out of those 83 who were on higher floors have accepted the floors below the 10th level, or at 10th and below level, and signed MOUs with us. This has allowed us now to go to the courts and HAL that we have an agreement between the buyers and us to cap this project at 10 stories, and we have presented a draft compromise document to HAL. It has gone through two stages of approval at their end, and the final committee meeting is expected in the near future. Once that comes through, the process is very simple. We take it to court and we say that both parties have agreed to these what's in the document there, and we apply then for the final approval to be the MD. The HAL draft approval and the subsequent submission to the court is imminent now. I can't give you a specific timeline because there's a third party involved which has to deliver the next step. But it is not months anymore. It's probably weeks or days now. Second part of your question was around the financials. The financials hold well. Milind will now give you some numbers in terms of what is the project size, and then you can extrapolate that in your workings if you want.
So, Aditya, we cannot give you NPV. It depends on many variables. But we would like to give you some data points. Now, this is going to be a 12-building project up to 10 floors, 2 buildings with 11 floors, and total area of around 8.5 lakhs. Out of 8.5 lakhs, 2.8 lakh square feet is sold to existing, the flat owners who are there, 83 flat owners. So balance sellable area is around 5.7 lakh square feet. The rate in that area is around 12,500. We are planning to put 1.5 lakh square feet commercial project for strata sale. We'll build it and sell it. And the cost estimated to complete this project, including commercial, will be in the range of 425 to 450 crore.
Just to repeat, it's 425 to 450 crores for cost to complete the project. And roughly, I think you might want to give the number of apartments that are still pending to be
230 apartments to be sold. So we have total 321 apartments, 83 are sold, and balance 238, sorry, not 230, 238 apartments.
So, Aditya, let me close this by the final comment that this is certainly going to be a value accretive project. And as I said in my opening statement also, Chalet has opportunities on its own balance sheet which can be unlocked to create significant value for the years ahead. This is one of those, and there are some more which we can talk about later. Thank you, Aditya. Can we move on to the next question, please? Next speaker.
Thank you. A reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Vikas Ahuja from Antique Stock Broking. Please go ahead.
Hi, sir. Good morning, and thank you for the opportunity. I have a couple of questions. Number one, in the presentation, you highlighted that the post-second wave in the month of June, the occupancy jumped to 47%, and it's more than 50% in July and maybe in early August. Do we think that 50 plus occupancy level will gradually improve, provided there is no third wave? And also, how was the ADR overall in June and July versus maybe 3,500 for the whole quarter, Q1?
So, thank you, Vikas. Yes, you're right in your assessment that the occupancies are now reaching sort of a steady state situation. The third wave is, your guess is as good as mine. So I won't hazard a guess right now on that one. I think we are, as a nation, better prepared for it if it does come by. Mumbai, as you know, Maharashtra as a whole has been extremely cautious on the opening up on account of the anticipated third wave. And even if it comes, I'm saying it's a matter of 1 or 2 months now for even that to come and go. So I don't see a mid or long-term impact of COVID post that. I think we'll be able to retain occupancy. I think it's important to also notice that the ramp up post the second wave has been a lot sharper than the ramp up post the first wave. So that's one. On your question on the average room rate, because as I did say that when I answered the earlier question, that we have been, I think our teams have been extremely efficient in picking up the special purpose group businesses that were available in the market. And the occupancies in some of our hotels have now hit, pretty high numbers. And if you were to look at individual hotel occupancies in the recent months, there are at least now 2 or 3 hotels which are now exceeding 50% by a big margin. I don't want to say anything more than that because we haven't given that as an open disclosure elsewhere. But especially for July and August. The ADRs have obviously been muted as a result. They are hovering around the 4,000 rupee mark. But the RevPARs are now comfortably over 2,000 rupees. And they've been when in July when we crossed over to roughly around 2,100 RevPAR, it was the highest we've had since March of 2020. August, as of now, is actually better than July.
Sure, sir. Thank you. And secondly, on the staff to room ratio, which has come down to 0.7, and you just told us that it may go up to 0.9. That is more of a normalized number. But are we also working on the pyramid, like by hiring more freshers or less experienced people to reduce the overall employee cost?
So to answer your question, right now there's not too much of hiring. I think it's very few. It's a handful of numbers that we would have hired in the last 3 months. But as we go down to ramp up our numbers when the business demands require us to, clearly we'll be looking at a younger, more contemporary workforce in Chalet, which is, the values are aligned with current times and the Chalet's values.
Sure. So overall, the in terms of savings would be much better than the staff.
Cost to companies will be lower.
Yeah. Okay. Sure. And also, I know you have answered this earlier to Aditya, but just want to come back to corporate side bookings again. Any early feedback you are getting from them in terms of the pricing or the contract? Because clearly, many of the corporates are now guiding for travel expenses coming back gradually from second half, because many of the sales guys will start traveling. And you have highlighted that hiring has been very, very strong in most of the sectors, especially IT and consulting. I mean, any kind of a feedback you can provide us when you're talking to those customers, how they are looking at in terms of pricing? Are they asking for huge discounts right now, or just trying to capitalize on the situation? I think any of the feedback. And last question is for Milind. Milind, if you can just help us with any kind of a guidance on debt for FY22-23, how it's going to be. Thanks. That's about it.
So because clearly the rates are muted right now, and even if there's a corporate rate which has been accepted and signed off by a corporate traveler, and if your rates online are lower, they'll take advantage of that. So right now there's no resistance to rate contracts, because rate contracts have this clause that they can choose the rate contract or what we call the best available rate for that day on our website. They have the option of doing both. So therefore the rates side, we haven't seen any specific guidelines from our clients. Corporate, whilst we've, as I said, 15% of our guests in the last quarter were foreigners, we haven't really had new RFPs signed with foreign companies, because they still haven't firmed up their dates of travel. And the big factor there is that India has really not announced opening up for visas as yet. So people around the world are not really able to plan travel, because India hasn't opened up travel for regular business or leisure tourists from inbound from other countries as yet. Once India announces that, we will then see a significant traction on foreign business travel. This is something that we've been following up with the government, that even if you can't do it immediately, why don't you announce an advance date, like UK did, and it worked brilliantly for UK actually. So let's see if that happens. It will definitely be helpful. But no resistance on the rates, purely because today your best available rates online are very reasonable, so people are opting for that rate. One more data point on foreign travel. I mean, Q4 last year to Q1 this year, the growth on foreign guests in our hotels is up by 61%.
So Vikas, on debt front, today we are at 1950 crores, and our debt will peak at around 2,500 crore in FY23. And we have planned capex of around 850 crores spread over next 2.5 years. Out of the 850 crores, a major part is for commercial of around 650 crores, and 200 crore rupees is for hotels. Again, hotel capex will depend on micro market conditions of the respective hotel, Pune and Hyderabad. So from 1900 to 2500 in FY23, and FY22 will depend on the capex which we incur in the balance part of the year.
May I just add to that? I think it's very important to look at what our debt profile is. You've got to actually divide that into growth capital driven debt and regular non-growth capital driven debt. And you'll find a majority of the debt on our books is actually growth driven. And that's an important factor for all of us to sort of recognize, which will then start being getting monetized over the next few months to the next 3 years now. So the ramp up on openings of the 2 office buildings, the third hotel, the expansion in Pune, the rebranding of the Powai Hotel, and Koramangala, for example. All of this will show very sharp returns. Koramangala, as you'll realize, is largely going to be funded through sales. So that may not have any significant impact except initial 1 or 2 months on the debt side, and that will be very small. That won't be too large either.
So Aditya, we don't want to give forward-looking numbers, but if you look at our operating cash burn for the current quarter, which is around 38 crore rupees, 39 crore rupees. As occupancy pick up and we have steady income and EBITDA from retail and commercial, we expect that operating cash burn will reduce on quarter basis, and that will be reflected in our debt. I mean, as Sanjay has mentioned, then whatever incremental debt will be only for growth.
May I just add to that? When Milind says operating cash burn is including interest cost.
Yeah.
That's not at operating levels. EBITDA positive is a given. We are talking about post-interest cost.
Sure, sir. I was just trying to see if there's any deviation from guided last quarter. This is very helpful. Thanks a lot.
We're actually very much on track. If anything, I think we should be able to do better because numbers are looking better, and I think Koramangala is a big move forward for us.
Sure, sir. Best of luck. Thanks a lot.
Thank you. Participants who ask a question, please press star and 1 now. The next question is from the line of Karan Khanna from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So firstly, when you talk about the occupancy that's 54% in July, will it be fair to assume that this was largely driven by MMR, or is it possible to get some flavor in terms of how, what sort of occupancies and what sort of footfall are you seeing in Bengaluru and Hyderabad? And as a follow-up to this question, since June we've seen a sharper recovery across the leading hotel chains, assuming there is no threat of another lockdown, is it fair to assume that the exit occupancies by end FY22 should be similar to what it was before the pandemic started? And also, what is your take on ADR recovery because of this?
Karan, thank you. I'm sorry I missed the second part of the question. Could you just repeat that, please?
Yeah, I was saying that given that we've seen a fairly sharper recovery since June across hotel chains, assuming there is no threat of another lockdown, how should one think about the exit occupancies by end FY22, and resultantly, what's your take on the ADR recovery because of this?
So on the first part, on your question about occupancies city-wise and whether it's largely driven by MMR, yes, MMR had a larger impact than any other place on the overall growth. but Pune has done well. We see Hyderabad picking up pretty well. Bangalore has been a little bit of a challenge for us because the Whitefield, Shajapur, Outer Ring Road market is completely dry because ITITS companies have really not moved, started coming to work and not traveling for business too much. But that will open up soon. We are confident of that. So to give you a reference, and if you talk, this is July occupancies, right? So Novotel was at 64, 4 Points Sheraton, Novotel Pune, 4 Points Sheraton 55, JW Marriott Sahar 77, Renaissance and MEA, that is Marriott Executive Apartment combined together, 53%. Westin had started climbing up rapidly in July at 46%. Bangalore still struggled at 28%. So besides Bangalore, which actually dragged the blended occupancy down, almost everyone is climbing up fairly well. We are very happy with the performance of occupancies at JW Sahar, 4 Points and Novotel, and Marriott Executive Apartment, which is in the 70s.
Sure. And the second question on how should one think about the exit occupancies in FY22?
I'm afraid I'm not going to be able to give you forward-looking numbers on that.
Okay, sure. No worries. Secondly, on your retail portfolio, you've been looking to re-strategize the Inorbit Mall. Can you help us understand how has the recovery been here since the opening post the COVID second wave, and what kind of rental waivers have you offered to your retail tenants?
So, post first wave, opening, the footfalls increased, and we could record the cost. And last 2 months, Inorbit Bangalore Mall is almost closed, and retailers have been asking for waivers on CAM as well as on rentals. So we are negotiating on case-to-case basis, but we have recovered the cost. We could break. There was loss of around 3 million at EBITDA level.
That is
for the quarter.
But I think July would be maybe slightly better. We don't have the numbers handy right now to give you that, and we will come back to you if there's any further interest.
Sure.
But just finally, Karan, to just answer this Inorbit Bangalore, I think there's an opportunity to sweat that asset in a different way. So maybe we need to skin that cat a little differently and get an optimized value creation out of that particular asset. So we're studying all opportunities, and the multiplexes are on hold, cinemas are not allowed to open. With all of that in play, we've got to have a long-term view on this one. We're considering all options. We will come back to you when we have something concrete on this.
Sure. That's it from my end. Thanks and all the best.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Sanjay Sethi for closing comments.
Thank you. Once again, thank you everyone for your time. Really appreciate the time that you spent on the call. We do hope you all stay well. And jointly, we look forward to better times ahead. Thank you.
Thank you. On behalf of Chalet Hotels Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.